In this video, we're going to talk about the GILTi tax, a critical piece of U.S. international tax policy that affects multinational corporations and individual shareholders alike. If you're an American who's thinking about going overseas, going offshore, having offshore corporations, having a Panama bank account, you're going to be interested in this because it's really made things a lot more difficult in recent years. So GILTi is an acronym. It stands for Global Intangible Low Taxed Income. If you're a business owner, tax professional, or just curious about how the US taxes foreign earnings, this video is for you. We'll cover what GILTi is, why it exists, how it's calculated, its impacts, recent changes, and what's on the horizon for 2026 and beyond. So let's get started. First, let's define GILTi. Introduced as part of the 2017 Tax Cuts and Jobs Act, GILTi is a tax regime designed to prevent U.S. companies and shareholders from avoiding taxes by shifting profits to low-tax foreign jurisdictions. It targets income earned by CFCs, controlled foreign corporations, which are foreign entities where U.S. persons own more than 50% of the stock. For individuals, GILTi applies if you own at least 10% of a CFC's stock. The focus is on income from intangible assets like patents, trademarks, copyrights, and licenses suspected of being moved offshore to reduce tax liabilities. However, GILTi doesn't directly tax intangible income. It's a proxy that captures high returns above a 10% threshold on tangible assets, assuming these excess profits come from intangibles. So why was GILTi created? Well, the US operates a worldwide taxation system, right? Where foreign profits of US companies are taxed. And before the TCJA that came in 2017, the US operated a worldwide tax system with deferral, meaning foreign profits of US companies were taxed at the full 35% corporate rate only when repatriated to the US. This encouraged companies to keep profits offshore, sometimes indefinitely, to avoid high taxes. You've probably heard about Ireland and Apple and Ireland and Luxembourg and all that. The TCJA shifted the US towards a territorial system, in a sense, where foreign earnings are generally exempt from US tax. But GILTi was added as a guardrail to prevent profit shifting. The idea is to ensure U.S. companies pay a minimum tax on foreign earnings, particularly those parked in low-tax jurisdictions, to protect the U.S. tax base. GILTi was also a revenue raiser to offset the TCJA's corporate tax rate cut from 35% to 21% under Trump. So how does GILTi work? For corporate shareholders, GILTi is taxed at an effective rate of 10.5% through 2025, achieved by allowing a 50% deduction under Section 250 of the Internal Revenue Code. This deduction reduces the standard 21% corporate tax rate by half for GILTi income. For individual shareholders, the tax rate is based on their income tax bracket, ranging from 10% to 37%. Unless they make a Section 962 election, which we'll discuss later. Foreign tax credits can offset up to 80% of the GILTi tax liability, but unused credits can't be carried forward or back, which can lead to double taxation in some cases. The tax applies to income earned by CFCs, even if it's not distributed to shareholders, making it an anti-deferral mechanism. So let's break down the GILTi calculation. And obviously this is going to be a little bit different for everybody. Use it. This is not legal advice, yada, yada. But let's get into the formula. So the formula is GILTi equals net CFC tested income minus 10% of qualified business asset investment, or QBAI, minus interest expense. Net CFC tested income is the CFC's gross income, including certain items like Subpart F income, income connected to U.S. trade or business, related party dividends, and foreign oil and gas extraction income. QBAI represents the average adjusted basis of the CFC's tangible depreciable assets used in its business. The 10% QBAI carve-out assumes a normal return on tangible assets, so anything above that is deemed intangible income subject to GILTi. Interest expense refers to costs associated with those tangible assets. For example, if a CFC has $1 million in tested income and $500,000 in QBAI, the GILTi calculation would be 1 million minus 10% of 500K, which is 50K, resulting in 950K of GILTi. A U.S. corporation would then apply the 50% Section 250 deduction, reducing taxable GILTi to 475K, taxed at 21%, yielding a $99,750 tax liability before using foreign tax credits. One key feature of GILTi is the high tax exclusion. If a CFC's income is taxed at a foreign effective rate above 18.9%, which is 90% of the U.S. corporate rate of 21%, it's exempt from GILTi. This election, finalized in 2020 regulations, is made annually and calculated on a tested unit basis, meaning separate entities or branches of a CFC are evaluated individually. This can be complex, requiring detailed books and records for each unit. The high tax exclusion benefits taxpayers in high tax jurisdictions, but adds compliance burdens due to the need for precise foreign tax rate calculations. Now let's talk about recent and upcoming changes. In July 2025, Congress passed the One Big Beautiful Bill Act, or OBBA, which replaced GILTi with the Net CFC Tested Income, or NCTI regime, effective January 1st, 2026. This shift refines the GILTi framework but doesn't overhaul it. Key changes include removing the net deemed tangible income return from the calculation, reducing the Section 250 deduction to 40%, resulting in a 12.6% effective tax rate, and increasing the foreign tax credit allowance to 90%, meaning no U.S. tax is owed on income taxed at 14% or higher abroad. The OBBA also limits expenses allocable to NCTI, excluding interest and research expenses, and modifies the rules for foreign-controlled U.S. shareholders and CFCs. These changes aim to align U.S. tax policy with the OECD's Pillar 2 global minimum tax of 15%, which we'll touch on later. So I know that sounded pretty intense, but let's talk about how GILTi, or now NCTI, impacts businesses. According to the Joint Committee on Taxation, GILTi raised $112 billion from 2018 to 2027, though its revenue impact is offset by the Foreign-Derived Intangible Income, or FDII deduction, which cost $64 billion over the same period. FDII, a counterpart to GILTi, incentivizes U.S. companies to keep intangible assets in the U.S. by offering a 37.5% deduction on export income, resulting in a 13.125% effective rate. In 2026, the FDII deduction drops to 21.875%, increasing the effective rate to 16.406%. 16.4%, let's call it. Data from the Penn-Wharton budget model shows FDII deductions doubled from $69 billion in 2018 to $139 billion in 2021, while GILTi deductions grew from $171 billion to $304 billion, indicating significant use of these provisions. So I know all this is pretty insane. GILTi's complexity is a major challenge. Multinational corporations must navigate intricate calculations, track foreign tax credits, and comply with varying state tax treatments. As of October 2024, 21 states and the District of Columbia tax some portion of GILTi, with rates ranging from 5% in states like Connecticut and New Jersey to 50% in states like Maine and Rhode Island. States like Alabama exclude GILTi entirely, while others, like Minnesota, recently increased their GILTi exclusion to 50% in 2023. This patchwork creates compliance headaches, especially since state apportionment formulas often don't account for GILTi's foreign nature, potentially inflating tax liabilities. Some argue this violates the Dormant Commerce Clause by burdening interstate commerce, though no legal challenges have succeeded yet. For individual shareholders, GILTi can be particularly punitive. Unlike corporations, individuals don't automatically get the 50% Section 250 deduction. However, a Section 962 election allows individuals to be taxed as if they own the CFC through a domestic corporation, reducing the rate to 21% with the 50% deduction. This can lower the tax burden but requires careful planning, as it may not always reduce overall taxes. Consulting a tax professional is crucial here. Maybe this is a good point to take a quick pause and mention that MyLatinLife, we're a full-scale immigration and offshore consultancy. We help Americans lower their taxes. We also help Canadians and Europeans lower their taxes. But me, myself, I'm a US citizen who's living offshore and dealing with a lot of this stuff day to day, helping hundreds of clients deal with this stuff too. So if you're interested in lowering your taxes as a US citizen, there's a link in the description where you can book a call with us and we can answer all your burning questions and we can take action and really do a lot of things in terms of creating a solution to help you lower your taxes, help you internationalize, etc. Looking ahead, 2026 brings significant changes. The GILTi to NCTI transition under the OBBA aligns with global trends, particularly the OECD's Pillar 2, which ensures a 15% minimum tax for multinationals in each jurisdiction. The NCTI's 12.6% rate is below Pillar 2's threshold, but the increased 90% foreign tax credit helps bridge the gap. However, NCTI's aggregate approach, rather than country by country, may clash with Pillar 2's jurisdictional focus, potentially requiring further U.S. reforms in 2027 when Pillar 2's safe harbor expires. Proposed reforms like the Biden administration's plan to raise GILTi to 21% and require country-by-country calculations could increase revenue by $785 billion, $750 billion by 2035, according to Penn Wharton estimates, but faces political hurdles. Another legislative proposal, the Close the Round Tipping Loophole Act, introduced in June 2025 by Senators Wyden, Warner, Warnock, and Welch, aims to deny the low GILTi rate to firms producing abroad for sale back to the U.S. This targets profit-sharing strategies and has garnered attention on platforms like X, reflecting growing policy focus on tightening GILTi rules. And by the way, if you're not following us on X or Twitter yet, link in the description to follow us on Twitter. We're super active there. So what does this mean for you? What does this mean for businesses? Multinationals must plan for higher effective rates in 2026, increased compliance costs, and potential double taxation in states taxing GILTi. Tax planning strategies like leveraging the high tax exclusion or restructuring CFCs to minimize GILTi exposure are critical. For individuals, understanding Section 962 elections and state tax implications are key to managing liabilities. In summary, GILTi, also now NCTI, is a cornerstone of U.S. international tax policy, balancing revenue needs with global competitiveness. It discourages profit shifting, but adds complexity and compliance costs. With the 2026 changes and Pillar 2 looming, businesses and shareholders must stay proactive. Keep an eye on legislative developments, as 2025 will be a pivotal year for tax reform debates. Thanks for watching. If you found this deep dive helpful, give it a thumbs up, subscribe, and hit the bell for more tax and finance content. Share your thoughts or questions in the comments below, and we'll see you in the next video.